Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Cucchiara.
Welcome in. This is Cucchiara with Real Estate Radio Live, your podcast series. Thanks again for tuning in. Before we get started, just a reminder, you could reach us by going to the website at 𝗟𝗓𝗡𝗘𝗖𝗓. You could also call me anytime at area code 408-838-9060. I'm here for all your financing needs, anything you need in terms of financing, purchase, refinances, restructuring. Also, if you're in the need of business partners, if you have anybody that you need, realtors, financial planners, CPAs, real estate attorneys, we're here for you. Anything and everything real estate. We're here to help you in any way we can. Our show today is going to be about alternatives to conventional financing. And this has been a popular topic over the years just because the kind of the standard financing that we know is pretty basic, and it could be confusing sometimes, but it's pretty basic. It's called conventional financing is what it's referred to. So we'll go over that briefly, but what I really want to cover is anything that's alternative to conventional financing. There's a lot of programs. And you might be surprised, and this would be for anyone maybe that has less than average credit, or maybe you're not quite qualified, maybe you have a tough time getting qualified, maybe you have a little less of a down payment, or it could be income-wise. Maybe you don't qualify, but you have a lot of assets or cash. There's some different programs out there as well. So we're gonna cover all these. Let me get started by talking a little bit about basic conventional financing, just to give you a quick picture of that. And that is conventional 30-year money. Typically, the three different levels are at, when your loan amounts at $417,000 here in the Bay Area or less, that's conventional financing, and that is conforming, it's called. And then the next step up is called high balance conforming. And that level is anything above $417,000 up to $625,000. Again, this is in the high-cost areas here in the Bay Area and many others of that nature. So if you stay, anywhere from over $417,000 to under $625,000, you're still in what's called conforming high balance financing, which is good rates, although the rates have come up recently, but still, you're going to get good market rates. Now, anything over $625,000 is considered jumbo financing. In the Bay Area and really everywhere else is jumbo financing. And that's where, honestly, the rates are still just as good in some cases as you can find conforming. The difference on jumbo financing is that you're going to have a lot different underwriting guidelines, the way they look at the loan, the expectations, the requirements are going to be a lot different. For instance, with jumbo financing, they'll need additional reserves. They're going to ask that you have at least somewhere between 6 to 12 months of reserves set aside in a 401k, investment account, cash accounts, of what adds up to your principal and interest, taxes, and insurance. So let's say that you're making a purchase and it's jumbo financing. Let's say your payment is including property taxes and insurance is roughly $5,000 a month. Then the jumbo lenders are going to ask that you have at least $30,000 to $35,000. In some cases, they're going to ask for $60,000 in reserves after the close of escrow. And this money would be in an account, again, that you could access, which would be a 401k, retirement account, cash account. And those are typically going to be requirements that are completely different on jumbo than they are with conforming financing. So that gives you kind of a quick picture, if you didn't already know, the basic financing. Now, if you have a credit score of over 700, roughly, and you have a good profile in terms of no mortgage late payments, no issues around your credit, you're going to get good market rates on conventional financing. So now we're going to start talking about what happens to alternatives to conventional financing. These are programs, but for one reason or another, people don't all fit in the small box of conventional financing. So these programs I'm going to talk about now are alternatives to conventional financing. So now let's first talk about FHA. This is the one that's commonly known by many, and that is a loan that's government guaranteed. And for a lot of people, they get started out with FHA. One of the benefits is you could put as little as 3.5% down. Now, in the Bay Area, it's tougher, too, because the maximum loan amount you could borrow on FHA is $625,000. So there's some limitations there. For most people in different parts of the country, that's not going to be a problem. But in the Bay Area, certainly it is a challenge at times. So the advantages to FHA are 3.5% down minimum. You could have less than average credit scores. In other words, if your credit scores are a little on the lower side, that's going to be fine. You're still not going to be penalized for that. And very liberal lending when it comes to flexibility. For instance, you could get unlimited gift funds for down payment if you'd like. You could have someone possibly go on the loan with you. You could have past credit history with late mortgages or late payments or some issues, pretty serious issues with your credit, believe it or not, and you could still get FHA financing. So those are the biggest advantage of FHA financing is for someone, I would say, that is trying to get into a house for the first time and they don't have that much down. That would apply to you. 3.5% is the minimum. Or someone that has less than average credit, you have some challenges there. FHA is going to be a good program for you. And some of the guidelines and expectations are a lot less. So that's where FHA is good. Now, the downside of FHA, which comes with, there's always a catch in terms of the cost that you pay because of its alternative financing. With FHA, what you have is an upfront premium of 1.75% of the loan amount that you're borrowing. They're going to charge that upfront. Now, it could be financed. It's part of your financing, so you don't have to come with that out of pocket. That's the good news. But the financing with FHA does come up with an upfront premium of 1.75%. It gets financed within that mortgage on their financing. The other side of FHA is that there is mortgage insurance, and the reason there's mortgage insurance is that it's guaranteed by the government. That's one of the reasons they have this liberal program with a lot of the flexibility. So what does that mean? You're going to pay a percentage each and every month. And again, depending on your loan amount, you could pay anywhere from $150 to $400 or $500 a month in what's called mortgage insurance, and that basically insures the loan. And that does go away. It's not there forever. It depends on when you get to a certain point with your loan to value, then that mortgage insurance does come off, and it has the ability to come off once you have 78% loan to value or better. So those are the downsides to FHA. But again, when you're just trying to get into a home for the first time, or maybe you've already owned a home and you're trying to finance again, sometimes FHA is a great temporary solution to financing for sure. All right, then we have VA financing. This is Veterans Administrative Financing. This is an outstanding loan. Geared towards the obvious one, to the veterans. Anyone in military or retired military service is eligible to use VA financing. The wonderful thing about VA financing for purchase is you could do 100% financing. In many cases, you don't need any down payment at all as long as you could qualify. One of the big advantages of VA. The other one is that there's a funding fee that they use for VA, but there is not a monthly mortgage insurance, and that is a big advantage for VA financing. For those veterans out there listening to this, either retired or current veterans, or I should say anyone that's in current military, active, non-active, take advantage of this VA financing. It's really good. The rates are great, and oftentimes they're better than standard conforming rates. And the only really downside to this VA, honestly, the loan, is that there's a funding fee, again, that's part of the mortgage, but it's not bad. It could be anywhere from 0.5% to 1.5% or more, depending on the type of loan you're getting, whether it's a refinance, purchase, those types of things. So VA financing is really good. If you have any friends, families, coworkers that are in the military or ex-military and they're still eligible, I would encourage you to talk to them about that or have them look into that and see if they're eligible, see if that's something they could do. Before we take our first break here and we continue the conversation about alternatives to conventional financing, real quickly, there's a program called 𝗓𝗓𝗓𝗓. That allows you to buy a home for as little as 5% down. There is some mortgage insurance there monthly, but there is no upfront fee. So there's some advantage with the 𝗓𝗓𝗓𝗓 program. And there's some income, there's some income expectations and income qualifiers around that. So you need to really understand it. But again, 𝗓𝗓𝗓𝗓 is another program that is wonderful. It's alternative to the conventional financing. Those are really, as I summarize it, when we come into the next segment of the show, I'm going to get into more private money, asset depletion, qualified IRAs, different ways you could get income. But the first part of this is really discussing a lot of the government-funded programs, which is FHA. To real quickly summarize, reverse mortgage is another one that's eligible for people over 62, and I'll get more into the reverse mortgage on the other side in our next segment as well. And then VA, and then 𝗓𝗓𝗓𝗓 as we summarize that. All right, we're going to take a quick break. When we come back, we're going to continue our conversation about alternatives to conventional financing. Again, this is 𝗘𝗀𝗁 with Real Estate Radio Live. For any more information, you can go to 𝗪radiolive.com. We'll be back with you to continue in just a couple minutes.
For more information on today's program, visit 𝗪radiolive.com. That's 𝗪radiolive.com.
Hi, this is 𝗘𝗀𝗁, host of Real Estate Radio Live and Bay Area Mortgage Planner. In addition to being your home financing expert, please remember you could always contact me for other trusted advisors such as realtors, financial planners, and CPAs. Please feel free to contact me at 408-838-9060. That's 408-838-9060, or email joe@𝗪radiolive.com, or visit my website at 𝗪radiolive.com for more details.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit 𝗪radiolive.com. That's 𝗪radiolive.com. Again, your host for today's edition of Real Estate Radio Live, 𝗘𝗀𝗁.
Welcome back in. This is 𝗘𝗀𝗁 with Real Estate Radio Live, the podcast series. Our conversation today and our topic today is alternatives to conventional financing. Before we jump back in, just remember, if you have any questions, comments, anything at all, you could always reach us at 𝗪radiolive.com. Always contact me directly at area code 408-838-9060. And just a reminder, I am the person you need to contact with any of your financing needs. If you need to purchase a home, refinance, any kind of financing, I could help you with that. If you want to sit down and structure a deal one way or another. And if you need any other resources in real estate, like a financial planner, maybe a real estate agent, CPA, real estate attorney, I could help you with all those trusted advisors. Again, you can reach me at area code 408-838-9060, or go to 𝗪radiolive.com. All right, we're going to jump back in, talk about alternatives to conventional financing real quickly. In the first part of the show, I covered FHA, VA, and then 𝗓𝗓𝗓𝗓 programs. Those are government-sponsored programs that are great programs for primarily low and 100% financing on the VA or low down payments. Now I'm going to switch gears a little bit. This is also, what I'm going to do is cover the reverse mortgage before I jump in this next series, because reverse mortgage still does fit into that bucket, if you will, in terms of the government sponsored. They are government insured, So let's cover that one before we jump into more of the private money and asset depletions. Reverse mortgages, you have to be 62 and a half or older to qualify. That is the major qualifier. The primary reason or how they qualify you on reverse mortgage is really your property. Some things have changed over the last couple of years so that they do look at your ability to repay. They look at potential income, assets, credit scores. But honestly, primarily the way they finance reverse mortgages is based on the loan to value and what kind of equity you have in your home. For instance, if you own your home free and clear and it's worth, let's say, $1 million in the Bay Area, and you want to get $300,000, $400,000, it's an easy way to do that with a reverse mortgage. And the best part about the reverse mortgage, hands down, is that you're not making monthly payments. That's the part that is attractive to some people, is that if you're short on funds, maybe you don't have that much in retirement, maybe you don't have much in Social Security, and you're finding yourself what most people call house rich and cash poor. It happens a lot here where people have a lot of equity in their home, but they don't have that much disposable income. Or maybe they lost some money one way or another and they don't have that much retirement income. Some people do resort to looking at the equity in their home, and a reverse mortgage is a great product like that if you understand it completely and if you work with someone you trust. So the reverse mortgage, again, the primary factor behind it is that you do not have a monthly payment. The way this works is that you would take a loan against your home. That money would come to you in form of cash or a line of credit. You could use that money. As you use it, there's no monthly payments. You might have to say, well, how does that work? The way that works is that it gets tacked on to the principal of the loan balance. So let's say you get a reverse mortgage for $300,000. And based on the interest rate, there is an interest rate and there's a cost associated with these loans. And they're fairly costly fee-wise too, and there is a mortgage insurance component to it, so they're somewhat expensive. But let's say for sake of conversation, you get $300,000 and the entire payment with mortgage insurance and the interest rate that you got the program based on is, let's say, $2,500 a month. So instead of making that monthly payment of $2,500 a month, what happens is that $2,500 just gets tacked on to the principal of your mortgage. So if you borrow $300,000 after the first 30 days instead of a payment, and that payment coming down, or I should say that principal coming down, what happens is that $2,500 gets tacked on to the principal balance. So now you have a balance of $302,500. And you can see what happens each month that it gets accumulated to the balance of your loan, and then that continues to build, and that is why they call it the reverse mortgage. The biggest advantage, again, for the reverse mortgage, this is for someone that is having a hard time meeting their monthly obligations. Maybe, again, you're struggling. Maybe you had some health, some costs that came up with health insurance or wasn't covered. Maybe you're laden with a large bill some way, and one of the ways you could take care of this would be to get a reverse mortgage. And I know some people that also get reverse mortgages, pay off some debt, put it in the bank, and they'll draw from it maybe a couple $1,000s a month, and they use it to actually live on for a while. And again, these are just alternatives to conventional financing, and that's the reverse mortgage. All right, let's move on and talk a little bit about private money. You hear about it all the time on different shows. You hear it on TV, see it on the internet. Private money, hard money, there's a couple different names for it, but this has really become a more popular resource lately, and it's because a lot of people are flipping homes or they need money quickly, and they don't want to go through the rigorous routine sometimes of financing if they need money quickly and they're trying to buy a house, let's say, to get financing. A lot of people will do what's called private money or hard money. And what's the difference? The difference is going to be something like this. Let's say you need money for a purchase quickly and you don't want to go through the regular financing. And let's say you want to borrow $500,000 to purchase, a rental property or a property you're going to turn around and fix it up and flip it. Or let's just say you need $400,000 for a purchase and you're not going to be able to come in until 6 months and pay that off. So something like that is going to cost you, again, this depends, but something like that is going to cost you probably at least 2 points, origination points. So if you borrow $400,000, that's going to be a cost of $8,000 plus standard closing costs. And then you're probably going to pay about, anywhere from 8.5% to 9.5% interest, but it is interest only. So you could see the interest rate is much higher than conventional financing. And that's the reason. The reason for that is because it's risk-based. And that's why they call it private money and hard money, is that it's available, it's out there, it's quick to get. In some cases, depending on what type of transaction you're getting, you could do it in less than 2 weeks, sometimes within a week. You could get access to those funds. The good part about this is there's typically, again, they're not going to look at all your assets, income, credit like they would with conventional financing. They're going to take a look at it, the lenders that lend this hard money or private money. But it's not going to be solely based on your credit score, your ability to repay. What it's going to be based on is what kind of assets you have, what kind of holdings you have possibly. They'll even leverage other properties to loan you money. It's really a very creative way to get financing, but it's expensive. But some people will tell you they love private money and private financing. Here's why. If they see a deal they could jump on and they don't have to wait and they can make an aggressive offer, let's say, and they find a property that they could maybe get for $500,000 and it's going to go quickly, and they think they're going to save $50,000 to $60,000, let's say they think they're going to save $50,000 to $60,000 by getting private money instead of conventional financing, by jumping on it quickly and making an all-cash offer. Then guess what? $50,000 to $60,000 savings. It doesn't sound like too bad of a deal if you're paying $8,000 in fees and 8.5% or 9.5% interest for maybe a 60 to 90 day period. Then all of a sudden that doesn't sound too bad. So private money is definitely an alternative. It's definitely something that's out there and something you want to look at if it is conducive to what you're doing. All right, let's move on. Just with a couple minutes left, I want to real quick cover asset depletion. This is what we do. Let's say someone is retired. Maybe they don't have traditional income. So we look at the assets that they have. And let's say they have $2 million in assets, but they don't have a traditional job. Maybe they took some time off. Maybe they're retired. And they really don't have enough income to qualify. We could take a look at assets and actually use those assets on a depletion program and give someone a certain amount of income depending on how much those assets are. There's a formula behind it. It's a little bit different with different investors, but the whole idea here is to convey to everybody out there that there are financing alternatives for people if you can't qualify for conventional, or if conventional is just not right for you. The last one I want to talk about is using qualified IRA income. This is used a lot. We use this on a regular basis. Let's say a person's retired. They're, let's say, 65, 66. They want to purchase a home, or maybe they're getting some retirement income, maybe pension income, but they're about $1,500 a month short by qualifying. And they come to me and they said, Joe, we really want to buy this second home. Technically, we don't qualify. What can we do? This is used a lot. What we'll do is work with their financial planner to see what kind of qualified IRAs or maybe qualified assets they have. And we could, again, give them what the income they need. In addition, let's say they need an additional $1,500 a month. We could use the qualified assets to do that. Give them the additional income, help them qualify, get a letter from the financial planner, and then we're on our way. We're helping them get their financing, and then they could change that criteria down the road once they close the transaction. All right, we are just about out of time. So again, thank you for tuning in today. And the topic was alternatives to conventional financing. I want to remind you once again, if you have any questions at all, go to 𝗟𝗡𝗙Radiolive.com. Do me a favor, give us a review. Go to 𝗟𝗡Radio Live or iTunes Give us a review and share the podcast with your family, friends, and coworkers. If you need to reach me, 408-838-9060. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.